LinkedIn and YouTube, we are the Business and Financial Times. If there's anything we've learned so far especially from the first plenary session, it's about innovation. Innovate or die. Join the digital train or find yourself out of business. Now, the second plenary session is also going to be an engaging one, and the topic under discussion for that is going to be Africa's robust securities industry, the role of insurance, pensions, fund managers, and other market players. So I'm going to be inviting the panelists to join us up here. So the first person here is Mr. Edward Foko-Che. He is the Group CEO of Glyco Group. Please let's give him a round of applause as he joins me up here. Mr. Edward Foko-Che. And then we have Miss Eugenia Bashe. She is the Managing Director of Tessa Capital Limited. Miss Eugenia, Managing Director of Tessa Capital Limited. And then we have Mr. Kobna Buama. He is the Managing Director for Stanbic Investments Management Services. Please join me up here. And then we have Nana Riafi Buama. He is the Chief Investment Officer for Axis Pensions Trust. And then Miss Jifa Fiati. She is the Head Group Business Star Life Assurance. Okay. Okay, so while we wait for our panelists to come from the holding room, I'd like to quickly acknowledge our sponsors and partners for this event: Stanbic Bank, Aza Finance, FBN Bank, Glyco, GCB Bank PLC. Thank you so much. We are grateful. And then Global Media Alliance, City FM, City TV, TV3, Onia FM, Asasi Radio, and Happy FM are our media partners. There's a short video of the process of downloading our app on Play Store. And if you are on iOS, just give us a few weeks. We will be there very soon, and then you can join the train of downloading our BFT app and then subscribing to the digital version of the newspaper. Also, if you want the hard copy of the newspaper, just see any of the staff around or the protocol team, and then they can enlist you on our subscribers list so that you can always receive even the hard copy of the newspaper as early as 4 a.m. in the morning. So our panelists are joining us at this moment. Please let's give them a round of applause. Thank you so much for taking time off to join us for this discussion. So as I stated earlier, our second plenary session is going to be on the topic Africa's robust securities industry, the role of insurance, pensions, fund managers, and other market players. And now that we have our panelists in here, I would like to mention them for them to fill the seats over here, and then our moderator, Alfred Okanse, will join us. So, Mr. Edward Foko-Che, he is the Group CEO of Glyco Group. Please, let's give him a round of applause. Miss Eugenia Bashe, she is the Managing Director of Tessa Capital Limited. Mr. Kwabna Buama, he is the Managing Director, Stanbic Investments Management Services. And then we have Nana Riafi Buama, he is the Chief Investment Officer for Axis Pensions Trust. And then we have Miss Jifa Fiati, she is the Head Group Business Star Life Assurance. And to the man to drive this conversation to a successful and fruitful end, we have our moderator, Alfred Okanse, who will be joining us up here to moderate the second plenary session. Thank you very much.
Thank you very much, and good afternoon. Great. So I think it would just be appropriate for us to put our hands together for the panel members. Thank you very much. To start with, we ended the first session, the conversation about fintechs, and there was the mention about how the various sectors are also going to be impacted by the disruption that fintechs are going to obviously, or are bringing, or have brought already. And the insurance sector, the pensions would also have their fair share of this disruption that we're seeing. So let me start off with you, that's Edward. For you, the insurance sector, and they're going to run through all of you as well. How are you leveraging on the fintech space for what's happening now and what is yet to happen for the insurance sector specifically? Yes.
Thank you so much. Good afternoon, and let me commend BFNFT for putting this together. We'll be looking forward to more of such opportunities to share ideas and to be able to address issues. Back to the question. I'm wondering whether we want to see it as disruption rather than adding to our businesses. You see, from where we sit, we're delivering a service in the insurance sector, in the pension sector, wherever you find yourself, you're delivering a service. And you're always looking for efficiency. And all we know is that even though technology comes with its own challenges, nobody can do away the fact that technology brings in so much efficiency. So if it has to do with efficiency, then I would say it is not disruptive per se. But then, in our space, what are we doing with it? At least, to begin with, as premium collectors, as insurance companies, as entities that rope in income that comes in trickles, you definitely need such arrangement to support you in doing so. And this is one of the spaces that I believe fintech has come to fill. You're also looking at payment of claims. Some claims may not be that significant, but whether it is significant or not in terms of quantum, it is important that it touches on credibility of our companies. And to be able to do so efficiently, it is important that we use some of these things. So yes, technology, fintech, as we're talking about, coming to disrupt, in quote, the system. I want to see it as something positive coming to us, and the fact that we can leverage on it to improve on our efficiency and also to get more, to be able to reach out to more. Insurance, as we know, is one area that penetration is low, and I believe that this is an area that we can use in enhancing on the penetration. So this is brief that I want to share.
Great point. I mean, the issue of penetration will come to that as we go on. Eugenia, for you as well, in the capital market space as well, and how you, and this is going to be a brief one, leveraging on technology, fintechs, as more of a complementary intervention and less of disruption. Yes.
Exactly. Thank you. As he rightfully said, I think it's more of a positive disruption. And for us, apart from efficiency, we are looking at the customer. how can we deliver better quality services to the customer, making use of fintech, making use of technology. So right through the customer journey, right from onboarding, right from investment decisions, right from to reporting. How easy is it for the customer to access financial services, to access investments using technology? And that has been our focus the past few years, to be able to deliver the same services to customers, to investors, without them having to walk into any physical office, but being able to do this electronically. Thank you.
Thank you. Alan, I see some telcos also now having some sort of collaboration with fintechs in the insurance space, for instance, where when you buy airtime, some amount that is if you subscribe to it, it's also used as some insurance for you as well. But for the banking space, maybe just briefly, Alan, on the collaboration that you're having with fintechs, especially to leverage on the opportunity that we currently prevail here and what's going to be happening in the future.
Thank you. So we see this as a collaboration, and it's a platform that enables scale. It's very difficult to scale if you're still going through the same mundane onboarding of customers and getting all of the customer information. But the fintech space provides the ability to onboard faster, validate the client faster, and also enables the client to be satisfied in consuming the services that you provide. So it's more of a platform to enable rather than a disruption for us.
Well, Nana, on the same point as well, and for the pension sector as well, there's collaboration.
All right, so I agree with Kwabena and Eugenia's submission. To add to what they said, as long-term provider of finance, we can also collaborate, by providing or financing some of this, fintechs, to grow, further within the constraints of our investment guideline. So that is how, we see how we can collaborate, giving them the necessary, push to grow and expand faster. Thank you.
I see, Jiva, there's a quick one on this as well.
I totally agree with what everyone has shared. In insurance specifically, we have relied on using the traditional means of distribution, using agents and brokers. But we realize that in Ghana, we haven't had so much mileage with this process, still below 2%, whereas in some other markets in Africa, it's about 17% to GDP. So we realize that we have a lot of untapped market. That's a lot that we need to do. And so we welcome fintechs on board to help us in reducing costs and to also be able to meet the demands or the needs of our customers. That's a lot of people we need to insure. And so we welcome them as enablers for our business.
And our conversation is on Africa's robust securities industry, the role of insurance, pensions, fund managers, and other market players. So let me stay a bit further with you, Jifa, for a good reason. Because over time, at least for the past 6 months, all the sectors within the financial space have had their own fair share of the impact of the domestic debt exchange program that we've been on. How is the insurance sector doing? From this Star Life perspective.
All right, we woke up last year with the news of DDEP as an industry. It has been very challenging and tough for us as a business because in insurance, we are actually promising people that we will be there for you. When the unforeseen event happens, you can always come to us and rely on us. So we are keeping people's money in trust that should the negative events happen to them, they would actually come to us and we'll bail them out.
With that said, DDEP has impacted us greatly as an industry in terms of our cash flows. We have made solid investments backed by regulation. We've been guided where to put our monies over the years with the hope that should the event happen, we'll be lucky enough to fulfill our promises. But this DDEP on our cash flows, it's a problem. That said, as an industry, we don't charge the right premiums. And so we are often making underwriting losses. And so investment has been a way for us to show our income, you know, to be able to take care of our customers. And so we are in a deep place right now as an industry. That said, on a company level, individually, companies have different ways they've been impacted based on your investment mix. And so I can confidently say that we at StarLife, yes, though we have also been hit, we've been able to diversify a bit. And we are hoping that when the losses arise, we would be in a good position to take care of all our customers. One other group that has suffered, whom we are not paying so much attention to, are our shareholders. Our shareholders would have to take a hit, you know, with this DDEP, and I believe that when times are better, we should remember to reward them in whichever way or incentives that are available.
I'm sure some of the shareholders are here. I was hoping what kind of reward you're going to propose they should be giving, because obviously, I think that's another group of persons who have not been considered in this entire conversation. Because as of September 2022, when I checked the records, at least with what the IMF made available to us during the spring meetings that just ended, we have commercial banks holding, as at the time, some 59.86 billion of the domestic debt, and there's part of it which has been restructured. And then you have the foreign investors, 16.33 billion. Pension funds, and now this is why I come to you. Pension funds, even though we're exempted, 10.88 billion. As we speak, we have the pension bondholders, they are picketing in front of the finance ministry's premises because some 19, that is coupons unmatured, have not been paid, and some principals as well. So how are you within that pension space navigating all of this, the impact of the domestic debt exchange program as we speak?
Thank you, Alfred. So, I mean, firstly, the DDEP didn't come as a surprise to us.
It didn't come as a surprise.
Yeah, I mean, seeing the trajectory of government borrowing, if we thought, I mean, something like that wasn't going to happen, and I guess we're living in Alice in Wonderland. So it was bound, I mean, to happen. Fortunately for us, and all of us who are probably pension contributors, the government exempted us. However, I mean, what we've observed is that government hasn't committed to paying the obligation that falls due on the old bond. And once you hold government bond and you are not receiving your coupon timeously, principal are not being paid, then you will be confronted with liquidity challenge. On the tier 2, side, we are probably fine, but I know some of the industry players are grappling with liquidity challenges on the tier 3 side. I mean, the only way we can get around that really is moral suasion, right? If you are due to withdraw from your level, from your tier 3 fund, we plead with you, to hold on. And let's see if government, will start paying, and then you can come for your money. So that is how we've been impacted. Government exempted us. However, they are not committed, to paying the obligations that fall due on the old bonds. So that's how, I see.
So even though you've been exempted, you are still not spared of the headache. You are still there.
Absolutely. And also, when they delay in paying, coupon, right, we don't receive that group income on the delay out. And that is really, losses, to our members. So
I say, but how is that moral suasion that you're doing working? So my investment matures, I'm coming to take my money. Then you say, oh, please wait. I'm begging you, hold on. How's that working?
No, I think it is facing, the truth. Really, historically, we have honored, obligations, from coupon payment and new contribution. And the coupon payment bit, formed, a bulk of our liquidity available for paying out beneficiaries. So if that portion, which is significant, is not coming through, and you need, your money, what we can do is to plead with you, right? Is to plead with you, exercise patience, and hopefully when government, pays, we pay you back. So really, it is what it is. I guess, pension, trustees would have to be upfront and communicate, the reality to their client so that expectations, are set right from the beginning. Because we are not getting those payments coming through. And once those payments are not coming through, we can't honor as many obligations, that fall due. Coincidentally, this DDEP coincided with the 10th anniversary of the Tier 3 scheme, which allows for members to withdraw without paying any tax. So we've seen quite a huge request for withdrawal because most of the pension schemes available just 10-10. So you just have to manage around that situation. What we did for where I work, if you've done your 10 years and you qualify for your payment, we can satisfy that obligation without sweat. However, if you've contributed 2 years, 3 years, and you insist that you want your money, then we'll apply the haircut, our colleagues at
In
the
the
fund
banks
manager
are doing.
side. Exactly.
So you do your own mark-to-market
Absolutely.
valuation.
Absolutely. And
Alan,
then pay you.
And you pay you.
Yeah, because the assumption is we are going to sell securities, right? To pay you. So if you haven't, waited for that 10th year and you want your withdrawal, firstly, you've taken us by surprise.
Oh, but it's time for me to take my money. So what is the surprise?
The surprise is, you haven't chalked, the 10th anniversary. And like I mentioned, we have to manage the liquidity situation. If everybody runs to withdraw, we'll be, exposed. So this is one of the measures, we put in place just to, stay, the hands.
I see. But when you explain to the customers, they understand, they're able to then keep their
we
money.
Communicated, early
Okay.
on. We had, various engagements, and I guess, our clients understand the situation we are all in.
Anyway,
Because really, if they also held, government bond, and they wanted
Indeed.
those bonds before maturity, they may have to go out and sell. And currently, you would sell at 40, 50%, discount, depending on your maturity. So.
Great. Alan, so 2 weeks ago, I was talking to Mr. Wah about the decision that you, the commercial banks, took, for instance, to support this whole domestic debt exchange program. The understanding is that you look at the bigger picture in saving the economy. But the evidence of that decision we are seeing in your end-of-year statements that currently is in the public domain, which by law you're required to publish the losses that a number of the banks are posting as a result of partly because of the domestic debt exchange program we cannot run away from. But how is the commercial bank space also navigating the impact that we're seeing from the domestic debt exchange program, which is not going to get away from you anytime soon?
When it comes to the commercial banks, like you rightly said, they have taken provisions on the back of these bonds that they held. And these are book provisions. And these provisions should unwind as we recover from this economic crisis. The key issue is, are the banks liquid enough to meet their obligations currently? And I believe the banks are. And they also have the support of the central bank in terms of liquidity support if the need be. So with respect to the commercial banks, I think the key issue is ensuring that they stay focused on what you're doing and ensure that at any point in time, they're able to meet their obligations in terms of customer deposits, and then so in terms of making sure that once the economy recovers, these book provisions that were booked are unwound to make them more profitable. And I think the banks that have published recently, you will see that their quarter one performance actually shows profits.
Indeed.
Yes. So I think it's a positive indication, and the trust that the economy will bounce back should give us confidence as we move forward.
So I'm also thinking about, for instance, now that the private sector is being charged with the responsibility of leading the path out of this crisis, the economic crisis that we find ourselves in. And you, the banks, are one of the major support mechanisms for the private sector in terms of advancing loans and so on. I speak to these private sector players. They are concerned that the banks are not advancing loans to them. Some of you have decided to hold on to some of these loan applications, obviously because of the difficulties that you're faced with right now. So how are you going to convince these people that, you know what, I cannot support your plans or your businesses, but then again, I'm looking at how the economy is going to bounce back as we speak. I just want us to understand that commitment, that conviction that you have as against the private sector now being given the responsibility to lead the process of recovery.
I think one of the positives when it comes to these economic crises that we've gone through is for us to be able to reset the economy as far as interest rates are concerned. I mean, as a country, it's nearly impossible for us to see the private sector grow, expand, when they are borrowing upwards of 30%. It's not possible. Was it in March? We saw Treasury bill rates drop, and people were asking questions. Why should the rates drop when inflation is above 45%? The real truth is that we can't have Treasury bills hedge investors over inflation. That's a misnomer in the economy, and that has to be fixed. If you want to beat inflation, you should be investing in long-term investments, not buying Treasury bills and doing fixed deposits. So if we're able to reset interest rates as an economy, we will be able to fund the private sector, and the private sectors will not be set to fail because they are not borrowing at 30%. They are borrowing at rates that they can't pay because our economy is growing at those levels. So I believe that's one thing we need to pick up from this crisis and ensure that our policymakers are going in that trajectory to support the private sector.
I see. I'm seeing the interest rates on Treasury bills actually started rising again over the last couple of weeks. So that's another concern that unfortunately you have to deal with. But Eugenia, so for you as well in the capital market space, how did this DDEP impact you and how you are leveraging as well on the possibilities of this economy bouncing back with the current situation that we have?
First of all, I think for us in the investment space, remember that we had just come out of first financial sector cleanup, where the reality is that the treatment we were given in the investment space was a bit different from what the banks received. And so we already had to suffer those shocks, where some of our clients still have their funds locked up. So that was the first thing. We were just about recovering. Then we had a regulatory directive which instructed a mark-to-market valuation of our portfolios. That caused disruption in our space. We were in the midst of that trying to educate people because really mark-to-market is not wrong. It's not a bad thing. It is a reality. When you have an investment, at each point in time, what is the value of that investment? If you are cashing out, it is the value at the time you are cashing out. That is what you should get. So mark-to-market is not a bad thing. So we're adjusting to it, okay? We're trying to educate investors as to why mark-to-market was necessary. Then we woke up and it was DDEP. So for
Another
us, it's been
one nightmare
one
after the other.
nightmare after the other. And we are trying to adjust. There have been promises, for example, we are still waiting for the liquidity support, the liquidity fund.
The 15 billion CDs?
Exactly.
It hasn't come
It
yet.
hasn't happened yet.
Okay.
So we are grappling with all the issues. Our investors need their money, and we have to deal with that. There are positives. Yes, I think the private sector leading the change. It's not a cliche. There are positives, definitely supported by the macros. But this is the time where, as intermediaries, we need to start thinking outside the box. The pension trustees, Nana and Co, will tell you, we were running to them and making them run to our regulator, MPRA, to say, let us breach the regulatory limits and put more money in government paper. Those days are over. We need to be able to demonstrate our worth as investment bankers. This is when we need to think. We can no longer run to government paper. We told our clients government paper is safe, but we are learning differently, okay? It still comes with risk. So this is a time where we need to be innovative. And that is where I think that the private sector and us as intermediaries in the space should start thinking of how can we take that fintech to market? Who is the next Bill Gates? I think the earlier panel spoke about when it comes to technology and the brains we have in our part of the world. There are a lot of young people who are doing great things in the fintech space. Who is funding them? Who is going to set up a fund to be able to help them to grow these small businesses to one day become the big apples of the world that we've seen in other markets? We need to lead that change. So yes, it's been a struggle, but I think there are opportunities we need to look at as market players. Thank you.
I see. Now, I stay with you a bit because you talked about the mark-to-market and the reason for that. I mean, no financial institution can survive a run on it. So that there was that basic understanding. But that mark-to-market valuation was occasioned by the current happenings in the economy. It wasn't something that existed until now. Okay. So how did you, or are you still getting, and I say are you still getting because I speak to people who still don't appreciate why you should be, I mean, I've put my money in your portfolio. I'm expecting 10,000 CDs. And then I'm coming for the money, and you tell me, okay, I'm using a different valuation, so I'll get 6,000 CDs. How do you get me to appreciate that loss as against the necessary decisions that you have to take?
It's been tough. Because when it comes to money, I mean, it's people's livelihoods. So, yes, we give all the explanations, all the education, and you finish and the person says, yeah, but I want my money. And that's the reality. We got to this point because we were in an economy where, or in a market where if there wasn't an active secondary market of fixed income securities. So typically, you invest in a fixed income security and you're holding it to maturity, and then you just take your final principal payment. And that is what you return to investors. Now there's an active secondary market. It was okay for the same investors when the secondary market was such that when you go to sell, because interest rates were stable, you actually sometimes make a profit if you have to get out before maturity. But we started feeling the impact of what was happening in the broader economy because the financial markets do not exist in isolation. Yeah. What happens in the economy impacts the financial market. So then we started seeing the impact of high inflation, the impact of increase in interest rates. The interest rates on the government instruments kept going up. And once that is happening, there's an inverse relationship between the price of a bond and interest rates. So now I go to the same market because Kwabena wants to make a withdrawal. Remember that I have invested the money. It's not sitting. He wants to make a withdrawal. I have to go to the market and sell instruments to be able to pay him. Now that market, at that point, to sell that security, is only able to purchase that security for me at a lower price than I originally bought it. Who is going to bear that loss? So that has to be priced into the value of the fund. So that is what brought about the mark to market. Because if you keep paying those who are exiting as if we are isolated from what is happening on the ground, what will happen is those who will be left in the fund, who will stay faithful to their investment goals. By the time they are ready to exit, you find that they would have a smaller value. So mark to market was important. We needed to be able to pay people at the right value. Unfortunately, it came at a point where interest rates had risen so sharply that the effect was that you see people losing 20, 30, sometimes 40% of the value of their portfolio. It's a hard pill to swallow. So what we tell investors is, don't withdraw because you are panicking. Don't withdraw because other people are withdrawing. If you don't need it, leave it. The market will recover. A couple of weeks ago, we started seeing interest rates on government papers, which most of these collective investment schemes are invested in. We started seeing them dropping, okay? And so once the macros become better, the interest rates will correct and your investment values would increase again. So it's education, education, education. I think that's all we need.
Great point. Thank you so much. Edward, so, I mean, for you as well in the insurance space, I think you heard about what, 1.7 billion thereabout in government securities. And so the DDEP obviously impacted you. But what is the current state of affairs now with respect to the impact that this domestic debt exchange program had on the sector?
Thank you so much. So far as the impact is concerned, I think it has been discussed all over. Discussions are still ongoing. What in times like this we need to realize or do is rather to remain focused, appreciating the fact that these are some challenges that comes as part of business challenges. And therefore asking ourselves, based on our mandate, based on our core mandate, what are we supposed to do in ensuring that we get out of this, in ensuring that we're able to perform better, to build the industry for the future. And that is what our concentration has been all this while, talking about the role we play as insurers in the financial market, the total financial market. What are we doing? Are we coming out of products that will cushion the patrons of our products? Are we coming out of better ways of investment that obviously will not put us into similar challenges in the future? These are some things that we should be doing as industry players, appreciating the fact that let's not stay away from our core business. Let's not stay away from what is expected of us, but take this space as something that has come up, but we need to think outside the box in getting some of these things done. And I believe that is what we are all doing, as already indicated by the earlier speakers. The situation is not hopeless. We should be able to go back to the core business. Core business, what are we set up to do as insurance companies, for instance? Just transfer of risk. So before these challenges in businesses were still existing. So assuming you don't have a way of addressing the existing challenges before this one coming in, how are you going to go about it? And these are some of the things that we should be able to do. The fact that we still remain relevant in the whole financial sector, we are still capable of introducing measures that will bring along our customers, so that we all don't throw our arms in air crying over some of these things. So that is where I want to pitch it from. So going back there, what are the key areas that we need to look at? I expect insurance industry to come out with products that will support individuals, that will support corporate bodies, that will support players within the industry so that they can concentrate on their core business.
I see.
That's
So
where I
you're
want to
getting
come.
into the diversified approach to insurance, and I think that cuts across all the sectors, and we not doing the same things and expecting different results, trying to look at the flip side of this economic crisis and so on. But if we're going to build a robust securities industry, and all of you have roles in there, we cannot discount the importance of customer confidence, right? And this DDEP and other events that have come up, and you ran through a few of them, Eugenia. Before the DDEP, we were dealing with the financial sector crisis and the impact, and then while we were recovering, we were hit with this one as well. How are you strategizing to restore customer confidence and improve on the confidence of customers as well to help build the robust sector that we want as a country? I'll start off with you.
Thank you so much. In the midst of challenges, opportunities are created. And that is where I want to come from. It is not going to be one-way approach. It is not going to be expected that you sit at your corner and have all the solutions. I expect regulators to be working with industry members. I don't think that prior to this challenge that we face in Cayman, any regulator had in mind or had in the regulations how such situations are going to be addressed. But here we find ourselves. And definitely they are part of it. They are part of it in the sense that they are part of the solution. And therefore it is expected that together we work hard. There are some regulations that will have to be changed. Some will have to be enhanced upon. For instance, talk about what we count in terms of solvency. Investments that are counted solvency. I can speak for the insurance sector, for instance, where we don't put so much value on, say, investment properties. But prior to this, it was all about invest so much in government securities. So is it not about time we begin to look at other investment areas that are very robust, that will ensure that at least in the future we're not going to put all our eggs in one basket? Definitely this is something that the regulators will have to come in addressing this area. And I believe it's about also looking at other lucrative areas. We may not have them now, but what kind of investments can we go into in addressing social challenges? For instance, if we are mobilizing so much money and we have a challenge of, say, accommodation, housing problems, is it not about the time that the regulators looked at how we can invest in these areas that will also be counted in solvency without necessarily discounting them? I think these are some of the things that we should be doing. And of course, the products out there should also be lucrative enough to be able to attract, in terms of the stock market, in terms of products on the stock market, should be attractive enough and should be educated enough. There should be enough education so that everybody can come on board. For instance, if you're talking about traders on the stock market, we usually restrict them to only the educated, the elite, the formal sector. If you're talking about real money, somebody will tell you that they are sitting at Makola, they are sitting at KJTIA and those places. How many people at Makola are players in the stock market? I don't think that the case is about Ghanaians don't want investment, because if anything at all, the sponsor schemes have taught us that Ghanaians are interested in investment, except that they are not getting the right areas, they are not getting the right education. And therefore, I think that it's about time that as we're trying to address some of these challenges, we take up some of these things and address it.
I mean, the takeaway from the Ponzi schemes reference will be that you have a lot more interest-driven investors. I mean, the Ponzi's, it is the interest rate they use as a bait to get you to, which the formal institutions cannot offer. Are you with me? So how do you use that as justification for, the point that Ghanaians want to invest?
That is where I'm talking about the need for education. The fact that some interests are not realistic. And therefore, once the person is well educated
Right.
about some of these things, and the person having some money to spend or to invest, because I know that there are some investments that one can conveniently go in and make better returns higher than the inflation without necessarily risking so much. So these are the areas that we should be looking at. Not too long ago, we were talking about, in Ghana, everybody is talking about roads. Our roads are bad. From Kumasi to Accra is so bad. Is it supposed to be only the government that should fix our roads? Is it possible that some investments can be pulled together from the private sector that will fix these roads and then charge?
So you put a toll booth on the road.
Exactly, and charge commercial rates. Until Zoom Lion, for instance, let me make reference. Until Zoom Lion, for instance, came to the scene, collection of refuse were the responsibilities of the state.
But you see, it's the first example, and I've sat through some fora that this has come up. You would have government consider that as against the public policy underlying factor of the cost element and looking at the public good. So even with the Tamamoto way that is supposed to be reconstructed and the tolls, remember when the Parliamentary Select Committee put out the charges, some of them are going to be increased by 50 pesos 1 cedi. The kind of reaction that you get from the public that this is too much. How do you then marry that against that proposal that, look, private sector can be put together for you to also invest in the delivery of public good, but charge commercial services for that to make your money back?
Thank you so much. I think it's about education and it's about convenience. For instance, if I'm traveling to Accra from Kumasi on a typical Sunday morning, say if I leave Kumasi around 6 a.m., within 2.5 hours, I'm in Accra. Why is it so? Because during that time of the day, there isn't so much traffic on the road. And you're able to make time savings. You're able to save fuel because you're not going to burn so much fuel. So you notice that at the end of the day, your cost will even be more without having the better roads we're talking about. So I think it's all about education. Continue to educate people and let them know, let them appreciate what they're going to earn at the end of the day, what they are giving off and what they are getting back. And I think it's doable because in the advanced countries or in some other parts of the world, these things are being done. If you don't want the speed or the properly built road, go and use the other one, but this one is for those who can pay. That's all. Then we can move forward with some of these
Eugenia, I'll bring you
ideas.
in at this point as well on the diversification to the approach of investment and then also the takeaways from this economic crisis that we find ourselves in to build this robust sector, the financial sector.
Okay, all right. So the recovery will require, as he rightfully said, education. Education, and it should be an effort, joint effort, regulators, industry players, we should all come together and push education to get people to understand. Then we need to be able to use technology to make information available. Transparency. When it's more transparent, there's more confidence. If I understand the dynamics of what I'm investing in, it makes it easier. And today, thanks to technology, there's more information available in a structured form. When I used to be a broker, to get access to information was a challenge. And I remember there was one brokerage firm that was known in the market for having a very good library. So they had all the financial statements of the various listed companies. They had all the listing prospectuses. So you had to make sure you had a friend in that company. And when you want information, you call that friend, you send a dispatch rider to go and pick it for you, you photocopy, and then you send back. That's how cumbersome it was. But today, thanks to technology, at a click of a button, you have access to information. Even on the Ghana Stock Exchange, you go to their website, there's enough information available. We should make that more available. And it's so easy to diversify if you go through the Ghana Stock Exchange. Look, if you decide to invest in Mr. X, who has a fintech company, for example, all by yourself, you are carrying that risk all by yourself. But if we help Mr. X as intermediaries to bring that company to the market, then it means that I will invest probably just 10 cedis in it. Somebody else invests another 10 cedis. If I lose that 10 cedis, it will not be as big for me as losing the big total capital he may require. Okay. So we need, as intermediaries, to be able to guide seekers of funds, hold their hands to bring them to the market. And also we need to be able to share information with those who have the funds to make them comfortable enough to be able to invest their funds into these enterprises. The days, as I said, of running to government treasury bills and government investments are over. We need to be able to come to the market with products that would attract pension funds, products that will attract other investors. And other economies have done it. Even here in Africa, you look in Kenya, South Africa, what have they used to develop their economies? Pension funds. We've seen some of those investments coming here into Ghana. Typical example that we can all see, for example, is Accra Mall. Accra Mall was built with funds that was put together by a private equity fund sitting somewhere else. Our pension funds today are valued at about $3 billion, Nana, if I'm right. 3 billion, I think, is familiar to us. That's what we've been struggling
To get from the IMF.
to get from IMF. We have it sitting here. The regulator has given us space to invest pension funds in alternative investments. What percentage of that have we used? We have space to invest in equities. So I can't even sit here and say we should get the regulator to increase the quota. Because what he has given us, we have not even used. Because we kept going back to say, can we do more government paper? Now we cannot do that again. We need to put our thinking caps on, show that we are investment bankers, and come up with products, and be able to channel resources to people who need it so that it can drive the growth of the real sector. And this is what will get us out of where we are today. Thank you.
Important point. Thank you. Thank you so much. Alan, so, I mean, look, financial literacy, I mean, I'll pick it up from there as well. It's generally low. But then, for you in the investment space as well, how can that be improved upon, especially because of what's happened now, and then also the other areas of investment, or generating or creating other areas of investment as against the existing ones, which have been a very comfortable go-to for a lot of the investment companies until now that we've had this rude awakening that we have to think outside the box. It cannot be business as usual. Alan.
Yes, Albert. I think for us, one thing is very clear, and we employ all investors to understand that markets go through a cycle. We are not at the end of our lives, not at all. We have just been at a situation where we've seen the lowest, probably in several years. But it doesn't mean this is the end of the story. The market will recover. And that's what we need to believe and accept, because it's important to have that understanding. Else we won't be able to see the recovery coming in. Then, in the area of investor education, I think one of the missing elements over the years has been the understanding of risk and overemphasis on products, take risk, and then two, his willingness to take risk. And earlier on, you spoke about the Ponzi schemes. People are doing Ponzi schemes, yet they don't have the ability to take that kind of risk. So the guy runs away with the money, and that's all his life. He takes all his money and puts in the Ponzi scheme. When it goes down, everything is gone. So that mismatch and misunderstanding of risk is a lot of work for us to do, and we are embarking on that gradually, so that clients understand that the moment you decide to invest, there's risk. In fact, you have two options. You keep the money at home for the robbers to try and impact your life, or you put the money in an investment and then you understand the risk with the investment. So whether you invest or not, there's risk. But what's important is understanding the risk you can take and making sure that your investment is in a risk that is affordable. Another way of looking at this is also, how much money do I have? And understanding that you cannot put all your money in one basket. You need to diversify. Earlier on, or prior to the domestic debt exchange, in fact, we've not spoken about savings account or fixed deposit, but it has a place. Invest. Leave some money in your savings account. No matter what, is easily accessible when you need that money. So spreading your investment across different investments will enable the client or the investors appreciate and go through the kind of times that we are currently in. And let me mention this one lastly. You know, we have different funds, different mutual funds. And most often, clients make the mistake by investing across different fund managers. That is not diversification. If the underlying investments that the fund managers are doing are the same, you have not diversified. You've only colored your investment differently. So he has investment in A, B, C, D. They are all doing Government of Ghana. Domestic debt exchange, it affects all of you. So it's important that clients understand the investment, and as investment professionals, we help them to see their risk tolerance and also the risk in the investments that they are doing.
And you see, also appreciate the fact that until now, a lot of the convincing by, you to clients or the public to invest has been a lot more on what they will get in terms of the benefit of the investment than the risks associated with it. Because I recall when this mark-to-market valuation started, and a lot of people will call TV stations and the media and say, we went there and they did, and I tell you, know what, bring your contract, let me read it. And it is in there somewhere. You bury it silently, you don't tell the people. Now, when things come up and they are asking for their money, then you refer them to something that you did not tell them when they were taking the decision to invest. So please, you to change your ways.
Yeah.
I mean, that's what I'm
It's
saying.
a lesson.
What I have here, improving customer confidence is, for us acting, indeed as a trusted fiduciary, for the longest time, we've placed, our interest above clients. And I think we need to apologize, profusely, to our clients. It's all about gathering AUM and making our fees, irrespective of whether the product, meets the client need. And we really can't blame, the client, for that. We really, didn't act well. Secondly, to build, confidence, we really need to act ethically, right? Many of the challenges that has been spelled out was because we were just unethical. The crisis we went through, so-called reputable firms that were supposed to know better, were just running Ponzi schemes.
Running Ponzi schemes?
Yes, we talk about, I'll mention the name, it's open out there, Men's Gold. Men's Gold wasn't the only Ponzi scheme. Asset managers were gathering assets, not because, they were competent, but because they could pay, the biggest bribe. Then we called it commission. So I'm the CFO of a company. I'll place money with company A, in as long as company A will give me 2-3% of the monies I'm placing with that asset manager. And that money is not mine, it's for my company. And that was a practice in the industry. Say it is only a jerk who does not take advantage of a crisis. And I believe, going forward, we just have to be a responsible fiduciary. We need to be ethical. And there were good, firms over here. We knew what was happening in the market. We knew the rogue ones. And we remained silent, right? Hoping that they would implode and then we can gather the assets. If we had blown the whistle on them, perhaps the industry, would have been saved. So it is what it is. I guess now we know, that there's no free lunch when it comes to investment. Again, on the back of the mark-to-market, discussions. We've rightly, peddled return, not giving, due consideration to risk. And indeed, every investment in this world, even treasury bills, comes with market risk. Because if you buy, treasury bills today as an investor, yourself, matures in 91 days. Something happens, you need your money in 30 days. You may have to sell. And the price at which you sell will be different from the expected value. So every investment comes with risk. And I guess, going forward, we as fiduciary need to emphasize risk hand in hand with the potential, return. It is only Bernard Madoff, Netflix, that can give you a return that slopes, 45-degree angle. If you see that, run away. Run away.
Thank you so much, Jifa. And then we'll come to the audience right after Jifa. So, we have a largely informal economy. I think that Edward mentioned that the penetration of the insurance sector is not that much within in the informal sector. And then you have all of this that has happened as well, which impacts on customer confidence to deal with. How are you also going to put the necessary measures in place to improve on the penetration of the insurance sector, not only in the formal sector, but the informal sector especially, as well as also diversifying the approach to selling insurance?
Thank you. So as in insurance, we've been hit with confidence issues. Over the years, our customers haven't trusted us that much. A lot has been done in the industry. In the last 2 years, we have embarked on a lot of education and getting customers to trust in us. We had gained some mileage prior to this happening again. This is no fault of insurers. It's a general thing that has happened in the economy. And so together with our regulators, education is very key. We're going to continue as an industry educating the public about the benefits of insurance. And when it comes to claims, we are going to be very transparent with our customers. I believe that any company in difficulty due to this DDEP would have the assistance of the regulator. The government has promised some assistance. And so I believe the communication is very, very key. And then onto the untapped markets. We're going to be employing a lot of technology, which we started doing already to reach the uninsured population. We're trying to simplify our products as much as possible, also with the help of the fintechs, to be able to insure a lot more people, to bring a lot more people into the pool. So insurance, it's a pool. The bigger the pool, the better, it is. And so we are poised. We are not giving up. We are not raising our hands. Yes, it has happened, but I believe that the industry collectively will come together and rise above the challenges and offer our customers the best.
Wonderful. Please, let's put our hands together for the panel. Great submissions indeed. So we'll go to the audience now. You can put up your hand. I think there are 2 microphones. Walk up to them, mention your name, and then please proceed with your questions. Yes, I saw a hand here. No, you can walk to the microphone. Thank you. Then, yes. There should be another one here as well, so the next person can stand behind the microphone on the other side. Yes, thank you.
All right, can you hear me?
Yes, clearly.
Thank you. My name is Mulenga Brian Matale with Aguilar Capital. We're a Canadian investment bank with an African focus. The way we normally work is obviously attracting international capital into countries like Ghana. We just did a transaction in January, and we have a couple more at work that should be closing in the next couple of months. So I've kind of latched on to what the asset managers had spoken about with respect to their allocation for alternative investments, which is kind of where we've made our bread and butter. And it's a lot of private credit funds in the UK, Europe, etc., that attract money into this market. So I understand you have an allocation of funding that you can play that way. What is attractive to you that the same opportunities we're presenting to these funds outside of the country that we can put in front of you, will you actually invest, and what it is about those investments would make sense for you? Because in most African markets where we participate, we do find, of course, really why we have a business is because of the inertia in the local markets, by way of whether it's regulatory limitations or a lack of innovation or just that reticence to want to participate. And I do sense that a little bit in the local market. And speaking to my local peers, I don't know of anybody who's been able to tap the pools of capital that you have at your disposal. So for us, the question is, okay, if I have those kind of investments that are attractive to non-Ghanaian firms that are looking to invest, if I bring the same opportunities to you, is that a waste of time, or will you actually seriously consider that and deploy some capital?
Okay, thank you. Yes, you can answer that. We'll go to the next one, please.
All right. So thank you very much, for the question. So yes, indeed, the pension, law allows us to allocate monies to private equity funds. And I think we have, room to do up to 15%, also. There's also room for external investment. And I guess, private equity firms domiciled, outside or registered outside will count within the external investment opportunity set. At Access, we have been very, deliberate about private equity. Together with our fund manager, Stanbic, I think we may have been the first pension fund, to foray into private equity. Obviously, those private equities are domiciled in Ghana, registered in Ghana. That doesn't end there. We are still, looking for opportunities. What do we look out for? We look at the track record, of the GP. We look at and the track record even includes the profile of the people behind the GP. It is a people's, business. And also the opportunity set. Once the opportunity set, makes, sense, we can get, some considerable, returns. Why not? The only challenge, it is possible, to invest if your fund is domiciled outside, but it takes a longer time to convince, the regulator and some of the fund managers along, that journey. But we are very, open to that. We are currently doing due diligence, on 2 funds that are domiciled in Mauritius that have approached us. We like their story. We like what they've done in the past. And if we are able to cross all the regulatory hurdles, we will definitely back them. It also gives us an opportunity to diversify our funds outside of Ghana risk, right? The CD indeed hasn't been a good store of value. Anybody who throws, me an asset in USD that is expected to generate, good return, I would definitely back. Thank you.
Thank you. Alan.
Just add a bit. So for fund managers, we advise the owners of money, which are the pension schemes, the employer-sponsored scheme trustees, as well as the corporate trustees. It is important to appreciate the fact that government of Ghana is no longer as risk-free as we thought it was. That realization then puts the owners of pensions to realize that it's important for us to diversify. If you look at the pensions report for 2021, SNIT had about 20% in listed equities and about 27% in unlisted equities. And guess how much they had in Government of Ghana bonds? It's about 7%. So all the noise about DDE, SNIT will not cry because they only had 7%. If you come to pension schemes, tier 2 plus tier 3, they hold about 85% Government of Ghana bonds. So definitely they will feel the pinch much more than SNIT. And what has happened has opened up the conversation, and we are still engaging, that trustees will begin to understand that it is very important that we diversify the pension assets and look at these alternatives which will help develop the economy. I mean, the developed markets have not gotten it all right from day one. They lost some money, but the lessons day after day have brought them where they are. Kenya, Nigeria, they all have allocations into equities upwards of 20. But Ghana, as we speak, pensions per the 2021 records had less than 2%. In fact, 2020 was about 4%, and 2021 is less than 2%. So these conversations, and thanks to BFT, education, when you meet your trustee as an employer, ask them, how much are they allowing fund managers to put into the real sector, into do alternatives, so that together we can create these assets that will help develop the economy. We talked earlier on about infrastructure, but the question is, it's not really about the cost of the infrastructure. It is the return comparatives. If there's an infrastructure fund that will do the Temamoto way, and we are going to get a return of 15% on it for the next 30 years, no pension fund manager or pension scheme will invest. Why? Treasury bills is giving you 19%, 20%, and he's not sweating. But if Treasury bill rates were 5%, what option do you have? It's important that we agree to reset our interest rates as an economy so that the alternatives become very attractive. And if you want to beat inflation, preserve the value of your investments, then you look at options beyond Treasury bills and fixed deposits.
Great stuff. Thank you so much. Please.
Do I have to do something?
We can hear you.
My name is Wisdom Anku. I'm with Pro Partners. My question is going to push you a little to the corner. Looking at what has happened so far, and particularly with the discussions so far, you would see that the regulators have been greatly complicit in all that we are experiencing today. Ghana is not an island. There's what we call best practices. My question would be, are our regulators giving us the best of services? Are we getting the best compared to what happens in other civilized societies? Thank you.
This corner, I mean, this corner that you put this before, I hope there are no representatives of the various regulators here. Who is a rep from SEC? Bank of Ghana? They are not here, please. You are free to go. Yes. They are watching it live. Please, let's block them.
I think
Anyway. Yes.
on the pension side,
Let me start off with Edward, then to you, Eugenia,
Well,
please.
that sounds interesting. But you see, regulators don't regulate in a vacuum. They use regulations in regulating. And regulations are put up based on existing situations. And therefore, at any point in time, whatever regulations that are being used to regulate us as players on the market were done considering the situation at the time. That is why along the line was suggesting that we rather ensure that moving forward, regulations would consider how to react to unexpected situations and be able to change. After all, nothing remains the same forever. But it's about how you react when changes occur. That, for me, is what matters. And therefore, I would propose that regulators have a look at some of these things and study the situations regularly in addressing some of these challenges moving forward in the future.
Thank you.
I
Eugenia?
don't think you can blame them so much because nobody anticipated that. And you see, one thing with regulators is that they are always so much interested in protecting the investor, but not the institution where the investment is made. That is their interest foremost. So always thinking about how would the public be protected. And I'm sure that is what has guided them over the period in fashioning out regulations that are regulating us. So moving forward, there will be the need to do something different.
Edward, we understand. Your regulator will be happy with you. But you see, the reality, if you say that, nobody saw this coming, I think some of us would disagree with you. But I can understand if you say the regulator wasn't proactive and all. That's fine. It's nice language. We are being politicians. It's okay. But the reality is that, look, we know what could have been done. Okay? Eugenia?
I think similarly, I would say that some of those regulations were in place because at that time, that is what the market required. For example, you had a new pension industry. We were now going into private pensions for the first time. Regulation was now being set up. So if you suddenly open the market and say, fund managers, you can invest in anything, there would have been chaos. So regulators needed to do it gradually. So they started with almost 100% in government paper, and then gradually they kept reducing. Yes, we should all have been a bit more proactive. We should have seen that that is not the best way to develop the economy. But I think the regulators have been listening.
Right.
And they've been more cooperative. They have set up mechanisms that make it more easy to bring innovation to the market. So we've all learned from what has happened. And I think going forward, working with the regulators, we should be able to avoid some of these things.
Great. Thank you so much. Please.
Thank you very much for the opportunity. My name is Eric. In one of Mr. Boame's responses, he suggested that the owners of the funds are the trustees of the various pension schemes. I beg to differ. The owners of the funds are the market women, the security men who are making their contributions. In the case of insurance, the policy holders. Okay, how do you explain mark-to-market to the market woman? How do you explain mark-to-market to a security man who wants to secure his pensions? I am hoping that by the end of this summit, I will get some good answers for these categories of people. Thank you.
Thank you. Yes. Alan?
Yes. So you're right. The trustees play a fiduciary role when it comes to the pension assets. And that's why I said they are the owners. But the underlying owners are the contributors who put money into the various schemes that the trustees oversee and have a responsibility to ensure its safety and then growth. When it comes to mark-to-market in our investor education, this is how I simply put it. I go out to buy oranges at 50 cedis, and then I have to sell the oranges to make profits. The worst I will sell the orange is at 50. I won't make any profit. then we are okay. But if I sell the orange at 30 cedis, it means that there's a loss of 20 cedis that somebody will have to pick. So in the same way, the investment that you have with us, we hold it at 50 cedis. If you want to withdraw your money and we go and sell to take money to pay you, that 50 cedis, we will only get 30 cedis from it. And therefore, when you come and you want your money, it is impossible for us to pay you 50 cedis because what we got from the market was 30 cedis. In fact, if we pay you 50, then we're becoming prophetic and we're taking other people's money to pay you. So it's an uncomfortable conversation, but that's the reality of the situation. And all we can ask is for clients or investors to forbear with the current environment. And if you don't really need the money, if it is not critical, we'd say endure, let the markets recover. Then you go ahead and make your redemptions.
Okay, is that clear enough? Can you go to the market woman with this one? That would help.
Oh
Okay.
yes. So going forward, I mean, in some of the fund manager space, what we have done is to ring fence new deposits, so that the new deposits don't suffer the market volatilities because they are not invested in any of the bonds. So yes, but it is not to say there's no risk. Let's understand, because if your new money has been used to buy treasury bills, and treasury bills are not honored by the government, you still have some risk. So we still say, understand where your money is going. If you are not comfortable, don't put the money there, so that you are not surprised. There are funds that are not doing treasury bills, so you can put it in there, understand what they are putting the money in, so that you are not surprised tomorrow when you ask for your money.
Okay, Joa?
So when it comes to insurance claims, for insurers, we don't have the luxury